What's up, everyone? We're on Own More Doors podcast. I'm super excited of our guest today, Scott Choppin. Scott is a builder, and he's going to tell us all about what he's into. What is it that makes his business unique? His business models. We're going to learn from what he's done right, some of his mistakes, and what he makes about the overall real estate industry right now in 2024. Scott, thank you so much for being here today.
Great to be here, Juan. Appreciate it.
Scott, tell us a little bit about yourself. I know that you're born and raised Long Beach. I know that you're well respected, and most people in Long Beach know who you are or know of you.
Maybe. My family's been here, so my kids are fourth generation in Long Beach. So I'm third generation. My grandfather moved here in the late 40s, 1949. And my family's been in real estate development since 1960. My uncle Mike and my dad were both developers in their own right. So, some deals around town that people might know. My uncle built the World Trade Center in downtown Long Beach, several million square feet of commercial office, a bunch of apartments, throughout Southern California. So my background really is I come from a family of real estate developers, and it makes sense. If you think about it, most people don't wake up one morning and go, "Hey, I'm going to be a developer." Like I just decided out of the blue. You usually have some exposure to it, right? Like you have some background in it. And when I was young, it made it, when you're a kid, you sort of do what you don't want to do what your parents did, you do the opposite. So I sort of, didn't know what I was going to do after high school. I actually went and worked in the electrical trades for a handful of years. In fact, in Long Beach, if anybody was around in the 80s, all the eightplex buildings, the eight packs, I call them, I've wired several dozens of those around town. But as I worked in the trades for a few years and sort of had what happened for me, Juan, was I had the background in real estate development, but I didn't necessarily know what that meant. Like it didn't mean what it does to me today, meaning how do you do it? What do you do it for? What's the purpose of it? I worked in construction and sort of knew this is what I didn't want to do. Like people that wear their bodies out. I mean, I made more money at 19 years old than any of my friends, but I had the background. Plus, I'm a pretty voracious reader. So when I was 19 years old, I started reading real estate books. Like go figure, right? Had a family background in it. And I read one of those, wacky books from the 50s, like how to make, $1 million investing in real estate on the weekends. And it was a cheesy book, but it was instructive because basically it taught me how to make deals. Like what is a deal, buy low, sell high,
Yes.
fix it up, raise the rents, that kind of thing. And when I finally had the development background come together with a deal understanding, like finally I got, oh, that's what my Uncle Mike does, what my dad Kerry does. And now I'd understood. And then from there on, it was like my mission from like 19 years old. I had to go get an education, go get a college degree. I knew I needed to work professionally for other people, learn the real estate development business. And I went from there. And then the only thing to add to that is I left my professional career working for other people in the year 2000 and formed Urban Pacific, my company. And that's, we're in our 24th year of operations this March.
Wow. Well, yeah, Scott, I've been following a lot of what you've done on YouTube and podcasts, and thank you so much for giving back. I know that I follow you on X, and people, you need to follow Scott Choppin on X.
I appreciate that.
I really love that on that platform, people are actually breaking down deals. People are saying, "Hey, I just got pitched this property. What do you guys think?" And like legitimate investors, people like you are commenting.
Yeah.
And I'm like, I think it's really, it's like, someone probably wouldn't be able to call Scott Choppin and say, "Hey, what do you think of this property? Here's the cap rate. Can you help me analyze it?" If they called you, I would think that it may be hard to get a hold of you. That's what I would think. But somehow you could post that on X, formerly known as Twitter, and someone like you could respond.
Yeah.
It's amazing.
I encourage people all the time when you're on X and, formerly known as Twitter. I tell people if you are not on Twitter and you're in real estate, you got to get yourself there. It is the most robust real estate network that I've ever experienced. Sort of social media meets real estate deal making, you meets real estate development, lenders, insurance people. I mean, anything brokerage, anything that you can think of that sort of like makes up all the different parts of investment and development in the real estate space. And then, like you just said, I would only change what you said is that, people might call me and ask about their deal. Could I vet it? And I always say that in the old days in real estate development, we never shared anything. Like if a developer called me, I'd be like, dude, no, I'm not going to, like, no, I did it. Like, no, I'm not going to, hey, Scott,
Right.
what did you sell? What was the cap rate? And
Right.
we sold? And I'm like, dude, no, like, forget it. Get out of here. So what I now use real estate Twitter as my place, my go-to place to both share and receive knowledge and information in an open format that doesn't exist anywhere else. I mean, it's a complete opposite of what us real estate guys are normally sort of holding close to the vest. And,
Right.
I'm not going to share, CoStar's calling me for my data on my sale. I'm not going to call them back, right? Or the
Right.
appraiser's calling. And, you have to be careful. Like there is, the possibility to share too much information. There's certainly, but I haven't found that limit yet. And I would say if anybody's in any format of development or real estate investment, if you're an investor, it is a place to go see what are other investors seeing, what are they asking questions, what's working for them, what's not. Like as an example, right now there's a big sort of discussion about general partners, who have raised capital in syndications or raised LP capital in value add deals, and the things that are going wrong with those deals now that we're in this new interest rate environment, and
Right.
values have fallen, cap rates have increased, interest rates have increased, and there's almost now this sort of pervasive like sort of dialogue about, okay, what GPs are good, and I think people are cautious to name names, but even you'll get people, they'll go, hey, I'm a GP or I'm an LP in a deal. This GP like totally screwed us over and da da da. And people are like, name names, and,
Yes,
and
I see that.
people are cautious. And I think rightly so. Nobody wants to get into legal trouble. But what I think where with Twitter it goes is then you go to the DMs, like the direct messaging off the public domain of Twitter or X. And then you go, hey, dude, I saw your tweet and you're, LP in that deal. Can, I'm an LP, maybe the same deal or whatever, right? Whatever the connection point is to why you would message on the DMs. And then you go into real life and then you have these whole robust offline in real life conversations and meetups and meetings. I mean, I probably have at least two, if not maybe more calls every day of people that I've met on Twitter, and I'm always trying to give back. Like I'd love to teach people and help them. And, we have an advisory offer in our real estate development business where we help people with their deals, like strategically and underwriting and project management, all that stuff. But I just love to talk to people. Like a young person will call me and say, hey, I'm trying to get a startup, or, I'm trying to start up a deal or start up my company, or I'm trying to
Mhm.
build my career. And a lot of times I'll talk to them and I try to keep it tight. I gotta watch my time, but I'll go, hey, go here, find this article. Here's an ebook I can share. I mean, I even created a whole learning community around the real estate development domain because there's so many people calling me saying, hey, I want to get in development. How do I do it? Where do I start? Like, who do I talk to? What do I do to get my first job? And I was getting so many calls. I said, hey, let me create this space and you guys can go there. I'm going to post all my questions, all my answers,
And,
ebooks, all that
and
kind of
where is
stuff.
that space?
It's actually called Real Estate Development 101,
Okay.
and it's hosted on a web platform called school.com. That's SKOOL.com. And you just look for RED 101 or Real Estate Development 101. You could just, search Real Estate Development 101 Scott Choppin and it will pop up. I mean, it's
And,
searchable.
I watched those videos, but I was able to get to them on YouTube.
I have a bunch on YouTube as
Yeah.
well. Right.
Okay.
Right.
Okay.
Now
So yes. So
the YouTube stuff is sort of more business oriented and I got a little bit of the learning. I should do a lot more. I mean, you're doing amazing work on YouTube and I look to, follow guys like you. But the real estate development 101 is really where I put all the learning stuff. So I have like a boatload of ebooks. We didn't come here to talk about that necessarily, but it's just really interesting as people like they're in the investment world and they think about getting into development and they start, what do I need to do?
yeah.
What's different? What's the, what do I know how to do? What do I not know how to do? And that real estate development 101 space, I go, look, go read the 8 ebooks that I wrote about how to do development, how to underwrite deals, how to check zoning, whatever the subject matter is. It's specifically real estate development oriented, but I would definitely encourage people to go there if they're thinking about it. It's,
Yeah.
it's all free. Like I don't, it's not anything I monetize. I just like to, throw stuff at people and, have it be good learning.
Scott, what I've noticed, the longer I'm in business, there's a couple things. So, sometimes we might start off in the world of brokerage. So I'm in the world of real estate brokerage, and then we want to get to the point where we're super busy and we have clients and we're well known. And then you're at that, and then you get to that point, and then I talk to people that get to that point, and then they're either like, "Man, I want to get into syndication. I want to get into development. It's like we're always looking for something new. And either is it we get bored, or we think we understood it, or we thought that it was going to be different. The goal was to, I think in most cases, I think in most cases, Scott, is people are doing this to make money.
Mhm.
Development, real estate, um, build wealth, generational wealth, all that kind of stuff. But then people get there and then they want to do something else.
Yeah.
So with that, let's talk about development, and maybe let's talk about your specific development,
Mm.
because you have a couple terms that I believe are really unique to what you've created and what you've done. Because when we talk about development, there's different levels of development. You're someone who builds single family homes and
Mm.
maybe like small tracts. There's someone that might just build smaller apartment buildings. Someone might do high rise. Someone might do high rise office. And so there's all levels.
Mm.
Tell us about your level, what it's kind of your unique proposition. I love, and I know we're going to get into it, your 5 4 3 2 1.
Mhm.
I think that's awesome. Tell us about what makes you guys special.
So, I mean, I think being a developer is like a relatively obscure career choice, like I mentioned before. And even people who are investors, they look at developers and it's still sort of a question mark about what they do. Our specialty has really always been, our company name is Urban Pacific, and I named it that way purposely because when I started it in 2000, we had my previous company had done a market study with a company called Robert Charles Lesser and Company, or they're now called RCL Co. And they're one of the major sort of market analyst companies in Southern California. And you pay them, you go, hey, what's in the future? What's coming? What should we be thinking about? And the guy at the time was named Bob Gardner, who was one of their VPs, and he wrote a whole study for the company I worked for about urban housing. And that was in 1999. And the guy I worked for at the time was this crusty old guy. He's still around, was sort of an ass kicking former, Marine Corps captain in Vietnam turned real estate developer, if you can imagine that kind of personality.
Mhm.
And I remember it was really funny because he's like, this is BS, man. Like, and he more or less threw it away. Right. And so I went and picked it out of the trash because I was like, this is interesting. Like I could, I was 31, 32 at the time. And I remember looking at it, I go, this is interesting. This is something new and different, and nobody's doing this. And that was urban infill housing. So building condos or apartments in places like downtown Long Beach. And you got to remember in 2000, like 1999, 2000, downtown Long Beach was a pretty tough place. I mean,
Yeah.
I'm a native. And you went sort of downtown at your own risk in the old days. It's much different now than it was, but it even goes through waves. And so why I bring all that up is because as a developer, really, I've always tried to focus on differentiating, right? Like the development world is sort of not a very innovative place, like real estate generally, and you'll get this. Like real estate isn't exactly cutting edge on use of technology, and I
Mhm.
think people are doing it very serious, but we're not a particularly innovative domain, right? Like a
Right.
lot of people are doing what a lot of other people are doing, and that's fine. I get that, but I've always sort of approached it like let's not do what everybody's doing. Call it contrarian, call it niche, call it uncommon, however it would be. So from the get go, why I mentioned this is that I started the company to facilitate like exploiting some niche that people weren't seeing that looked different, that looked cool, and for me at the time living downtown, I go, oh, that seems like a really cool idea. Like, why wouldn't more people want to do that? And at the end of the day, from 2000 to like 2005, that world blew up. I mean, urban infill became like every home building company, every big public builder, every developer in Southern California was like all over urban housing.
Scott, do you think other people paid that same company for the same forecast that you guys saw?
That one, it's a good question. Yes,
Yeah.
definitely. Like you're not getting anything and you have to be mindful of that.
Right.
And so even though you might recognize, like in fact, Bob Gardner, the guy I mentioned before, his whole thing, he had this, I saw him at PCBC, Pacific Coast Builders Conference. I don't remember the timing around when they did the report, but he sort of overlaid the millennial demographics ascendance in the demographic stack, right? Like they were becoming adults and they were starting to rent. And so his thing was that where do demographics cross over with housing? And he was overlaying. I remember seeing this thing, and you could see, the millennials being the kids of baby boomers, which themselves were the largest cohort in U.S. history.
Mhm.
Well, the millennials were even bigger, right? They were even larger. And so as you start to see them coming into their years to rent apartments or buy homes, you could see that overlaid with sort of the housing cycle and a couple other cycles. But what was interesting is that this millennial demographic was not going to be a traditional home buying demographic for various reasons. One is affordability, which turns out that's pervasively known today and a big deal, right? It's a big issue. But what was interesting at the time was that the millennials were not going to be living, they didn't want to live in the suburbs. That was like, they were like, no way. I'm not, that was where I grew up there. That's where my parents live.
Hmm.
And, I think the next generation is always sort of like quasi rebellious that way. And so that was sort of the combination of that plus my recognition of it. So Bob was like he was out evangelizing about urban housing. And so he would talk to anybody who would listen to it. But it really wasn't so much that he was commonly sharing that with many other developers, is how does the developer receive it? And did they do something different with it? And that's
Yeah.
really where I think where I shine is I'm always looking for the cutting edge. What's different? What could we be doing that's not what everybody else is doing? And look, you do a lot of what other people do. I'm not saying none, but I'm always sort of looking for the niche, the cutting edge. Because at the end of the day, I don't want to have to compete head to head with Trammell Crow or Holland Partners, the big guys who, if it came in a recession and I'm trying to rent units up and they're trying to rent units up, they're going to crush me, right? They have,
Yep.
huge financial statements, cost of capital, that kind of thing. So the genesis of, the development company and the logic around the name and what we do has always been about uncommon offers, about differentiation. And then so fast forward to your point, the last several years, we worked on a version of what we call workforce housing that we created called Urban Townhouse, or UTH for short. And what that is we build a 5-bedroom, 4-bathroom townhouse rental unit, right? So in Southern California, people might be used to seeing the 3-story condo format, 2-car garage on the ground floor, and then it's a for sale condo. We're doing that format, but we're making a rental housing unit. So it's never going to sell, it doesn't have a condo map or anything like that. And it's meant to house multi-generational middle income families. That's really sort of the key to the offer, is that in California, we all know we have an affordable housing issue that's pervasive, like it's in the media every day, and,
Hmm.
and more so than it's ever been. But what's sort of missed is, like, if you think about the market, you have a spectrum. On one end, you have the luxury housing, high income renter will rent, cost is no object, right? They got plenty of money. On the other end, you've got the true affordable, in other words, families that are truly in poverty that really do need reduced rent housing. But what's forgotten is this middle income demographic. Think like a salt of the earth working class family. Everybody's gainfully employed. Even the family may be multi generational. They have 2 or 3 or 4 income earners. So they're pulling down 30 to 50K a piece. But when they combine their incomes together in the family group, well, all of a sudden that family's making 120 to 150,000
Hmm.
a year, right? And so they're overqualified for the true affordable. Like, they make too much money to qualify for the government subsidized housing. But at the same time, on the other end of the luxury spectrum, that high-rise 1-bedroom in downtown Long Beach doesn't suit their family lifestyle. It's
Hmm.
it's it's sexy, but it's not for them, right? They've grandparents and in-laws and kids and adult kids, right? They need, really, a house would be the traditional format that they would go into, but of course that most of those families can't afford the down payment and the income qualifications to buy a house. So what we've done is injected a new type of rental housing into that demographic, in the locations that they already live, sort of the, peripheral urbanized suburban neighborhoods around different cities in Southern California. And so we've exclusively gone to this 5-bedroom, 4-bathroom product, and 3-story townhouse, 2-car garage, and then we build one unit over and over again. And that's the 5-4-3-2-1 that you described earlier.
Yeah, no, I think that's amazing. So, um, before you, no one was building 5 bedrooms.
No one's building 5 bedrooms now either.
Got it.
Yeah,
Got
but
it.
you're right. I mean, you might find 5-bedroom houses, and then there's a couple guys in LA that did really specialized 5-bedroom, like stack flat, sort of for sale units. But we're really the only group that's done it purely rental and at scale is the real key.
Um, One of the things you talk about is the demand for the 4 and the 5 bedroom apartments. My mentor, Mark Milan, longtime native of Long Beach, he's an investor in Long Beach, and what he was doing. Now, this only worked at a certain time of the market, but he was buying 5 and 6 unit buildings and going to the city and downsizing them down to be a 4 unit.
Mhm.
And in his mind, he was creating larger units, which he knew there was larger demand because
Mhm.
of the demographics here in Long Beach. He said those are going to rent up quicker And then also when it's a 4 unit, then there'll be a bigger pool of buyers when he goes to resell. So when I've heard you say, well, what you were doing is making 5 bedrooms, but it was new construction.
Right.
Mark was simply combining two bedrooms and
So was he
removing a
taking an
kitchen.
8 unit into a 4 unit?
Not that big. So typically be a 5 or a 6 unit and making
Gotcha.
it into a 4 unit.
But he was
Uh,
taking a 2 bedroom next to 1 bedroom, combining that into a 3 bedroom unit, stuff,
and
stuff like that.
sometimes it would be a 4 bedroom because
Mhm.
then you got to pull one kitchen out.
I got you. Right.
And then the city at that moment was really in favor of the downsize, and so then what ends up happening now, like fast forward, I'll get some of the clients will call me, they'll give me an address. I'm like, oh, I know that property, like I know 1701 Cedar Avenue because that one was a 6 unit, now it's a
Mm.
4 unit, and now they want to trade it, and,
Yeah.
and they're like, it's kind of unique. One of them is a 5 bedroom. Like, I know why it's a five
Yeah. Because
bedroom
that guy did it.
because
You
he did it,
know.
because
Yeah.
Mark did it.
Yeah.
Yeah, but to your point, so I guess a couple questions. When you're building these UTH, so urban townhomes,
Mhm.
are you having to? I mean, I guess tell us the difference between workforce housing and call it low income
Mhm.
housing, right? Because there's two type of developers going on right now,
Right.
and we hear workforce a lot, but
Yeah.
probably more like in South LA. We're going to hear the
Mhm.
word low income housing. Yeah,
Right.
or low
Or
income housing.
affordable might be the,
Affordable might
yeah,
probably be the most appropriate
attainable.
term. Yeah. So like what's the difference? And I guess do you fall into the category where the products that you're building, are you having to meet some type of like, hey, you can't, is there a deed restriction on how much you could, like, does that apply to to your product or no?
Generally not. In fact, the UTH model is really neat because basically what I say is we're pairing private capital with a workforce housing model. Now you go, what does workforce housing mean? That's the next question. And those terms, affordable, attainable, workforce housing, are all have sort of loose definitions. So if you say it to me, think of it one way. If you talk to somebody else, they'll think about it a different way. So I sort of have to define it every time I speak it. But earlier I talked about the true affordable. That's what I call, some people call it big A affordable. Think of it like government subsidized, maybe public housing, but it's the type of affordable housing that's like built from day one purposely to be rent restricted, reduced rents, reduced incomes, and built purposely for people who fit into these low or very low income categories, right? So that's what I call affordable or true affordable or big A affordable, and there's different terminologies for it. Workforce housing is sort of like adjacent to that. The definition of workforce housing is even more loose, but what I mean by it is it's sort of that space in between luxury and low income or true affordable housing. So it's a maybe middle income family, moderate income. Some people might be familiar with that term, but my idea is basically that this is a family that doesn't they make too much money to qualify for the government subsidized housing, but they don't afford the luxury from an income perspective. And so they're middle income and therefore in the middle between those two extremes on the spectrum. But I call it workforce housing because basically these families that we house are working class families. They're
Mhm.
all, if we have a family of six, we'll often have two or three or four wage earners in the household. Everybody's out producing, everybody's got a job. These are not people who are on government subsidized welfare. These None of these people have that. These people are like salt of the earth. This would be old school middle class one if you were to think about it. These
Mhm.
people are working. Many of the families, one of the earners is entrepreneurial. These people are out like they're working their asses off to make a good life for their families. They don't take public subsidy money generally. They're not, often, and we do rent to Section 8 families sometimes, but that's not the predominance who if we rent to. So for me, workforce housing is that working class family. Think blue collar, working class, salt of the earth family. They produce a good life for their families, but they need a housing type that is as coordinated with that, right? That's coherent with their lifestyle, meaning that can house their family and do it affordably. Does that answer your question? Hopefully.
No, it does. I guess the first question I was asking is are your units restricted
Hmm.
with the amount of rent that you're allowed
No,
to ask?
no.
So the answer is no
Yeah,
to that.
correct.
Talk to us about how does Scott, because these are when you're saying urban landfill, these are like, so people can, so if we're talking Long Beach, we're saying, hey, we find a lot that is suitable size for you. The zoning is suitable, and then you're like, okay, I'm going to tear down that old house that's burned down or whatever.
Hmm.
Someone brings you the deal, or your team finds it. Talk to us about From a macro level, like what are the steps that you're taking to be able to underwrite the deal to say, yeah, that's going to make
Yeah.
sense?
Let me just define urban infill a little bit. So I just call it that because, I try to differentiate between, out in the hinterlands of Inland Empire where you're building on green fields is what people call that. In other words, it's virgin dirt that
Hmm.
no one's ever built on before. Urban infill is the dead opposite of that. So it's exactly like you described. It'd be, in Long Beach, it'd be in any neighborhood in Long Beach. It could be on a major street. It could be on a small street, but basically it's some sort of vacant land or underutilized property that we can, if it's got the right zoning, we'll capture that. If we need to rezone it, we do that quite often. Government entitlements is a standard thing for us. But we're really looking for that underutilized property where we can enhance the value of it through the zoning and the build out. What we don't do is we are not a buyer of existing apartment projects that we tear those down
Hmm.
and then build new housing. The main reason for that is it's not economic. Apartments are so valuable in their existing condition, no matter if they're, old or new or good or bad, right? Just the sheer economic, power of units, like your idea of like combining units together today. I don't think that would work because apartments are so expensive to buy that you'd be losing ground on per unit basis. If you could talk about a revenue enhancement and higher NOI, then great. But I think that might be difficult in those days, in today's, era. But we're just finding underutilized type things. So to underwrite, basically we have economic underwriting, we have physical geographic underwriting, but first we'll start with location. Is usually we're usually land centric. So in others we're looking for land deals, or people are sending us land deals, and we'll work from that first. Maybe we identify an area and we'll go drive it, or tell our brokerage friends, hey, go find me deals here. But for us in this sort of moderate income workforce housing, we want to be in what I call urbanized suburban locations. And so in Long Beach, that would be, the Anaheim corridor, right? So you drive down Anaheim, Anaheim's sort of built out, it's got retail, it's got some apartments, it's got some commercial, but behind it are the single family homes. So if you drive down the side streets, it turns into a suburban community, but it's much older. It's sort of grown up a little bit more. It's not like your suburbs out in, Irvine or someplace where it's just, houses as far as the eye can see. It's got neighborhoods, it's got commercial, it's got stores, it's got, some fabric. And so we want to find those kind of neighborhoods. And so for us, we would find places that were two or three neighborhoods outside of the central business district. So we wouldn't build in downtown Long Beach ostensibly,
Hmm.
but we might go to the west side, over by like a location we built was like at Oropesa or Cesar Chavez Park.
Yep.
And that's like older apartment buildings, some houses. We found a lot over there. So that's like a perfect sort of urbanized suburban community. We used to be homes, sort of built up into some apartments, and then we're finding underutilized lots in those areas. And so we'll go do that throughout Southern California. And really, we're searching for the way I describe it is we build an A product, so it's brand new, like market comparable finishes, quartz countertops, new appliances, the whole shoot matches for what a new apartment would deliver. But we're going to deliver that into a B and a C neighborhood, so that would
Yeah.
be not an A neighborhood. So it would be not a we're not going to be in war zones. We're not looking for that, but we're going to definitely be in that neighborhood that's seen better days, is older, probably has, and we go there one because that's basically where our families already live. So when we built our first deal in Long Beach, we had a guy who worked for one of our investors. He was like a runner for the guy was a broker at Keller Williams. And I remember the guy visited and I was like, hey, dude, let's go check out the unit and try. I didn't know him at all. But as we're walking around this four bedroom, the first one was a 4 bedroom, 3 bath townhouse. I remember him saying, he goes, I could see my family living here. I go, yeah, tell me more about that. He goes, oh, yeah. So I work at Keller Williams. It's 20 minutes away.
Hmm.
And then he said, "Oh yeah, my kids go to school at the school like a few blocks away. My church is down the road a little bit. And by the way, my extended family lives close by, and so we could occupy this unit. It's big enough for my family because he had a larger family, not a huge family, but not a small family either. And we were close to his job. We're close to his network, like social network of family and church and school. And so I really came to the arrived at the idea that this is our tenant avatar. We want a working class person who already lives in this sort of existing neighborhood fabric in Long Beach or any city that we would build in. that all their stuff is around them, right? That
Mhm.
their social networks are strong. And the reason for that is basically, if you look at the opposite, like, if you're building the mid-rise and high-rise, one bedroom product, it's a great product, but who lives there is a single person, maybe a young couple. They're often going to be younger, they're going to be professional, and they're going to be mobile, right? And
Mhm.
those are all perfectly natural things for their lifestyle.
Right.
But what will happen in a recession is those people will lose their job and then they're gone. And nothing wrong with that. This is not a criticism of that type of demographic. I just say I don't want to rent to that person. What I want to rent to is the family who is going to stick here no matter what. Not for being taken advantage of, but like when recessions come, these families, they batten down the hatches, they circle the wagons, whatever metaphor you want to use, but they're basically figuring it out. They're going to figure out how to make money. They're going to figure out how to create businesses. They'll figure out how to get, one or two or three jobs. They pool their resources together in the family group. And what all that does is it makes them much more robust in any environment, whether it's good times or bad times. They basically are really sticking together. And what that does for us is that basically gives us a great tenant to rent and be a really great tenant. But also the trade is we give them a great unit in return, right? Like we honor that family demographic, that family structure that they have, and go, let us give you a unit that serves your family for the best life for your family. And then we want you, of course, as a long-term renter. One of the bottom lines that, all your owners will appreciate, the turnover rate on these families is like incredibly low. Like we
Right.
have very little turnover in comparison to just
Well,
a regular, institutional type of deal.
well, that's what I was thinking when you were describing the high rise and the single person. And yeah, they could afford $2,800 studio. But the first thing that came to mind, I'm like, yeah, but that's, whether they get laid off or whether they get an offer to go work in Seattle, there, when you said like the chances of them moving is much, much higher versus this, what you're talking about, multi-generational families that are living together. Yeah, they're going to be there forever.
Right.
And yeah, so then the turnover for you is much, much lower. Um, you brought up talk to us about the very first one you did in Long
Mm.
Beach. How many units, what street,
Yeah.
how old were you, and were you scared?
I can't. I'll have to think about how old I was, but the first deal we did was 325 Daisy Avenue. So the closest cross street would be Third and
So
Daisy.
that's down for people listening. That is somewhat downtownish.
It is downtown, but if you look at it, it's on the periphery. It's like on the almost very end of the west end of, you only really have really one more street, which would be Golden, and then you're to the 710 freeway and Chavez
Right.
Park. You're like at the very edge of it. You're right. I call it downtown adjacent.
Hmm.
You could easily walk to Pine, in 15 minutes, right? Like very, very
You could see
accessible
the high rises, but they're not.
for
But
sure.
but they're not on that specific
But that
block.
but that neighborhood is not a downtown type of neighborhood. It's families.
Yeah.
It's just regular salt of the earth people. It's not the sexy high rise dwellers, and nothing wrong with those people. But at the end of the day, this is sort of your blue collar neighborhood. I mean, I don't know how to else describe it. And it's a great neighborhood. I mean, it's very safe. Schools right next door. Families, kids out playing. Right. It's got that whole sort of feel to it. But it's definitely a much older part of downtown. It's a fair amount of apartments, some houses mixed in, that kind of thing. So it's 325 Daisy, and we actually ended up buying it's the tiny parcel we bought from the city of Long Beach, from their what used to be the redevelopment agency. They
Mhm.
had a bunch of land assets that they owned, and we were actually it was a local commercial broker in town, Becky Blair,
Mhm.
and she represented the city. And I've known Becky forever, and actually Shiva Jose Zeta, who works with her. And so we just put like we said, hey, the city releases it. Hey, we're going to sell this property. It was tiny, Juan. I mean, I knew when we bid on it, like no one was going to bid on this thing. It was,
Mhm.
and by the way, it was in a weird location. It didn't face the street. It was on the interior of the block at the cross of the two alleyways
Mhm.
in mid block. Like
Okay,
literally
so
your front door would be the alley and
yes, yes.
no street frontage, although it had a Daisy address. It didn't actually, wasn't facing it
In
Daisy.
the city of Long Beach, something that faces the alley is typically on a court. So
Yeah.
if it ends at like Daisy Court, then you know you're
Yeah,
on the
right,
alley. Yes.
exactly. Yeah,
Yeah.
they name the alleys. So because we bought it from the city, we bought it really well. I think we paid $90,000
Eh,
and
uh, uh, so $90,000. You said it was small, but you didn't.
Mhm.
What size was it? So we kind of wrap our head around more or less.
gosh, I want to say it was maybe 3,000, 4,000 square feet. It was tiny.
Okay.
And
Wow. Okay.
we ended up putting all of 2 units on it. And
Okay.
what's funny about that, 2 units, nothing wrong with that. I'd never done 2 units in my life. I mean, we were doing projects that were like hundreds of units for
Okay.
years and years. But at the time, I just like we were always after trying to buy land from cities, like because you can generally get either really great pieces of real estate or you can get really cheap real estate or maybe both, right?
Mhm.
And when we bought this thing, I didn't necessarily know, like I didn't buy it and go, hey, gosh, we're going to do these townhouses on there. I did not have all that mapped out. But we made our bid, and I think we had, probably a few months to close it. So we were in no big hurry. We opened escrow, that whole thing. But out of the design process, I think I described earlier, which is, we hired the architect and, we go, we can only do 2 units, but we can do really big units if you want. Did I
Mhm.
tell that story?
No, tell me,
Okay.
please. Yeah.
So when we got the site, as I always do, we get the site and we start to do diligence. I'll send the site to the architect and I go like, what can we do there? Like, and I might have usually I have a strategy. Like, hey, we're going to do multifamily, we're going to do rental housing, it's going to be attached, it's going to be this and that. And I'll sort of give the architect like a little bit of a guidance on like strategically what it is. And then I tell him like, see what you can come up with. And when he came back, he goes, "Oh, we can get 2 units. The zoning code allows 2 units." I'm like, "Oh, really? That's all, man?
Yeah.
Geez, like that's not good." But he goes, "But there's something interesting." He goes, "We can make the units bigger if we want." I go, "Oh, okay." Because up to that point, we've been doing studio 1 and 2 bedroom units in all of our recent projects in downtown Long Beach and throughout Western United States. We're doing a lot of projects. And I said, "Well, how big?" And he goes, "Well, let me get back to you." So he came back and he had a 4 bedroom, 3 bath, 2-story townhouse with a 2-car garage. And I go, "Hmm." We've never done that product. Like that's totally off the radar for us. But I also knew from my background and working for other companies, particularly in the affordable housing domain, I knew fundamentally that there'd be somebody who would want to rent a 4 bedroom unit. It would be a roommates, maybe it's a family group. At this point, we didn't know who that was. Later on, that guy toured who sort of gave me the idea for the avatar.
Mhm.
So we bought the deal, we raised the capital, we did the design, we did the 4 bedroom townhouse units, and then the great ending of that story is we finished the deal, we put it on the market, and we got an offer for all cash and like a good price, and we could make money with it. But the caveat, the guy says, I don't want you to rent the units. I want to rent them. I want to use my property manager. We'll rent the units. And so at the time we were proposing and we had underwritten the deal at $26.50 a month
Mhm.
for that 4 bedroom, 3 bathroom townhouse for the rent,
Yeah.
right? We'd comped it out and did the whole thing. Well, the day after we closed, the guy puts it out on the market at 32.50. And I saw it and I was like, oh, okay, what's that? And so I called the guy who is the partner investor and I go, dude, what do we miss?
Yeah.
I mean, 32.50 from 26.50, that's a huge delta, like massive, like one I'd never seen before. And the guy who was the investor, he's like, yeah, I don't think they're going to get it, dude. I mean, that seems like a real stretch. And I remember sitting there, I go, I think maybe they might. And they actually did. And so that was the genesis of what became the urban townhouse unit type, project type, because it dawned on me that basically we knew better who was going to be the tenant, would be some sort of a family or roommate
Mhm.
group, that they had the capability to pay 32.50 a month for a 4 bedroom. If you divide 32.50 by the four and get the per bedroom, you could start to get the math and then you could start to extend that to new properties. And so once that one worked, we go, what more of that can we find? Like, what else is out there that could do this kind of 4 bedroom product? And we actually found another site at 1719 Cedar, 538 Golden. And then we found one in Fullerton, and we started to like expand out a little bit geographically.
So let's go back to the one on Daisy because
Mhm.
a part of today's show, I kind of want to show. So this was your early 30s. You've now left the company that you were with because you were going to be
Mhm.
have your own company. This was your first actual development under Scott Choppin
No,
name.
no, yeah, sorry. I left some out. No, this would have been 2017, 2018. So I started the company in 2000. So we were already 18
So you
years.
guys were into it already. So
Well, like I'd done, thousands of units by that time. So
okay.
this was a post GFC. So the environment and real estate development after the 2008 era had everybody super skittish. Everybody was sort of scared, including us. Like when's the next recession coming? And I remember at the time in 2016, we'd finished a group of projects and we sort of had this moment in time to like sort of pop our heads up and look around for something else to do to differentiate. So Daisy popped up in that time
Mhm.
period. And although we didn't know we're going to do townhomes, I said, well, look, we're buying the land for really inexpensively. Let's experiment. That's the terminology I use all the time. Like,
Mhm.
this is an experiment. Let's see if it works. If it doesn't, fine. Let's make sure it doesn't kill us. If it works, then great. And so because we bought the land so inexpensively there at 90,000, like we could mess the thing up badly and still, do
Be okay.
okay, get our money back and move on to the next one. But in this case, it actually worked really well. In fact, if we had underwritten at 3250 originally, we probably never would have sold the thing. It worked so great, or we would have sold it for more money. But it made sense at the time because it was a good cash deal. So no, this was well into the life of the company, but I think it's a good demonstration of like our ability and our want to pivot. Like we're always looking, like let's not get stuck, because that was our lesson from 2008 is, you sort of follow the trends and people are doing condos, so you do condos, people are doing apartments, so you do apartments, this kind of thing. And the entire development business is sort of following each other and, sort of a web, right? And so what I learned in 2008 is if you're going to do what everybody else is doing, then you have to be prepared to suffer the consequences that everybody else suffers. And of course, because everybody's doing it, there's going to be a lot of it. So like the
Mhm.
example in 2008 for us was doing condos, like
Mhm.
urban infill, middle and high density condos, or adaptive reuse of older office buildings into loft condos, which is a great, sexy, urban infill type product. The problem is when the market went against us in 2006 and 2007 and mortgages were no longer available and all those buyers disappeared, being in condo deals was like the absolute worst space to be in. Like they're hard to rent, it's hard to like change them into something else and sort of, make something out of like a dead condo deal. So from that day forward, I basically said I never want to be in a position where I'm stuck in a deal type or unit type or location. And so I was always sort of mindful that's, we got to do really great deals. We got to buy land really well. But particularly we have to be differentiated from the trends enough to not get caught, right? So like we did a deal in Denver at the time, and I remember we finished the deal in 2012 or 2013. And I remember at the time there was like 10 or 15,000 units of new apartments coming online in Denver.
Mm.
And I remember telling my partner, like, we got to get out of this thing. We got to get, man, these apartments are coming
Yeah.
and they're building over the next year or two. I do not want to stick around for this. So we ended up selling the entitlements, the land deal with the entitlements, and we sold it to Lennar. And so those are the kind of moves that you start to make. So you're either ahead of the pack or you're separate from the pack in some way. And so the urban townhouse model was both ahead of the trend of multi-gen workforce housing, but also separated from the pack because no one else is doing it. And that's still sort of the way, but although the idea of workforce housing is now much more pervasively discussed and it's on people's minds and
Mhm.
they know they need it. The idea of people talking commonly about affordable housing and the need for it, even people that are non-real estate people, didn't exist 10 years ago. Like no
Right.
one was, if you told them affordable housing, they wouldn't know what that was.
I would imagine that the 5 bedroom, 4 bath model may not work in areas where the demand for the multi-generational families is not there, right? I mean, so it's probably, I mean, obviously here in Long Beach, most parts of LA,
Hmm.
we're probably going to see it, but it could be that if you go out of state trying to do that, just, and I'm just thinking about some of the listeners who, listen, we have listeners nationwide, and I'm thinking if they're thinking something like this, someone would have to do their homework. Is there
Yeah.
demand for something like that
Yeah.
in where I'm
I,
located?
I think our opinion is this works in every major metro in the United States that has a larger population. You're not getting this is well, I mean, it could work in rural places if you were doing farm worker housing, but
Yeah.
any place that idea of economic sharing is practical, where people, roommates or co-living is an example of
Mhm.
that, right? Co-living is the same version of what we're doing. It's just for really high-end, sexy, young, Melrose Place kind of folks,
Yeah.
not working class families, but congregate care and senior housing. That's co-living. That's economic sharing. It just happens to be for seniors that are congregating together to like have it be more affordable. So the idea of this sort of economic sharing idea is really it's becoming much more pervasive for two reasons. One is culturally, the United States has a makeup culturally and demographically where there's many more people who are naturally and historically live multi-generationally. So if you were from South America, or you're from from the Far East, or from India, living multi-generationally would be like the standard. In fact, if you didn't live with your family, would be looked at to be weird, right? Like why are
Correct.
you doing that,
Yeah.
right? But in America, we had for a moment in time, we had the nuclear family with, mom and dad and two kids, and the mom, dog, and the,
Yeah.
car parked in the, driveway, that whole thing. But historically, we lived multi-generationally, and then now we're starting to grow. In fact, Pew Research did a study that they said that the United States has the highest percentage of people living multi-generationally since 160 years ago.
Interesting.
But then that's sort of the cultural makeup, but also the other part of it, which is really the main driver, is economics. So if you think of housing cost inflation and just inflation generally, money printing, the loss of value in the dollar and our monetary system, that's putting pressure on people. I mean, it's all over, social media. I'm working, 40 hours a week. I can barely, afford my life and pay rent, do all those kind of things. And if you look at who those people are, what you'll notice is that they're often people that live by themselves.
Hmm.
They're living in a studio unit and they're paying for everything themselves. And I don't, people reject the idea of having to live with other people to take care of their economics. But look, I'm a very practical, pragmatic person. You do what you got to do,
Right.
because if you can't sustain your life, you're going to get, pushed out of your apartment. You're not going to have enough food to eat. So you may have to do other practical things. And one of those is living with roommates or living with your family. Moving back with mom and dad is sort of the anti-hero story. Like that's a loser proposition. But I go, look, the reality of the United States, where we kick people out at 18,
Yeah.
like, hey, Johnny, go live on your own and pay rent and pay for gas on your own. That's dumb, right? Like you go, hey, I got a house. Like this is what I tell my kids, my wife and I, hey, come back anytime you want. Like
Right.
our house is here. I mean, from a familiar standpoint, but I also go, give yourself an economic break. Graduate college, come live with us for 2 years, save your money, get on your feet, whatever. Try to, keep debt like that down. So I think that's just one example of like the now much more larger trend of people sharing economics and housing and other things. I mean, generally sharing cars, VRBOs, sharing houses,
Yeah.
right? Sharing in a living situation where you're living permanently. And I think just that's an economic force.
Scott, so because you're creating a product that is in demand and doesn't exist, I would imagine that your vacancy and your absorption. So, folks, when I say absorption, is Scott's a builder. He's going to build a product, and they need to anticipate how long are they going to sit vacant after they're completed before they're rented. Um, how does that look like for you?
Yeah. I've always described this product as recession resilient, because in my mind, these families, because they're practicing economic sharing, they're able to, gather the wagons around them and sort of become defensive. And so the idea is that if you have four incomers in the family and one person loses their job, well, you still have three other people to pick up the slack. So the
Mhm.
family doesn't have a breakdown. They just have to sort of shift the load between the income earners, right? And that's true with roommates. That's true with anybody who does economic sharing. So what that does is it makes them very robust, tenants. So we talked about turnover is low. Absorptions, I think is your question, how these absorb. They absorb actually brilliantly. And so I'll give you an example. We're just leased up our project 1115 Artesia in Long Beach, and I was scared to death. I mean, it was the first project that we'd finished, and it's the last in that wave, sort of pre-COVID wave, but it was the last one to finish in that series, and everything else had done well. But we're going into a sort of a strained economy, right? People are losing jobs. Everybody's under economic pressure, and I was really worried that we were going to open the doors on this thing and have crickets. I mean, that's like every developer's nightmare. Like that's where the rubber meets the road as a developer. It's like I
Mhm.
finished this thing, I open the doors to lease it, and whoever shows up shows up. I mean, marketing, and you're doing all this stuff.
It's almost, well, it is a business, and it's kind of like your grand opening day.
It is, and the corollary I use, it's like making movies, and you put the movie out in the movie theaters, and then you see how it's going to do. I mean, you
Yeah.
can do all kinds of testing and stuff like that, but at the end of the day, you put the thing out in the theaters, and either it works or doesn't work. And renting apartments
And,
the same.
and so, how many units were there?
That one was a really small project. We did two projects in the COVID era when, all the craziness was happening in 2020. We basically said, look, we're going to shut all new projects down. In other words, we didn't kill any projects, but we didn't acquire any new projects that were bigger. We said, we don't know what COVID looks like, But I found a couple interesting deals, 1491 Atlantic and 1115 Artesia, that were really close to home.
Yeah.
The land was, was a good price. We had good zoning on both those. And so we undertook those at the time. And so what's back to your question?
The one on Artesia is how many units?
Yeah, 5 units, right? And so
Okay, so that one's 5 units,
that's 5 units. Yeah.
and they're all the 5 bedroom, four
So
bath.
that one was a weird design. That was 3 of the units are 5 bedrooms. The fourth one is a 4 bedroom, and then the front unit has a little storefront like live work thing, and so that's a 3 bedroom. So that one's a little bit different. Usually we only do 5 bedrooms,
And,
and that
what was the just for our listeners, so they
mhm,
kind of, so this is brand new product. Everything is new.
yeah.
What does a 5 bedroom rent out for in Long Beach?
So in that one we range from 3850 to 4000 a month.
Okay, which is a tremendously good price,
Yeah.
because I think if I was if I was selling a 8 unit building or something out there, and we had a 3 bed 2 bath, I'm probably thinking, okay, if we fix up this unit very well, we're
Mhm.
probably same range that
In the
you're at.
threes, you should be
Correct.
in the threes.
Easily,
Yeah,
easily.
right.
Yes, correct.
And so that's where I always want to be. Is in fact because comparables for 5 bedroom apartments are almost impossible to find. Like
Yeah.
there's zero in general. In
Right.
fact, now we're almost sort of getting back to see comps from our old projects that we sold.
Yeah.
But we'll take a 3 bedroom, and then the math we do is, let's just for easy math here, we say that 3 bedroom is 3000 a month, divide by the bedroom, so that's $1,000 per bedroom, and then we'll times that times 4 or 5, often 5, and that sort of becomes our proxy rent to compare to a 3 bedroom. But then we have to adjust down because we're not going to get 5,000 in most of the market, so we'll
Right.
adjust it downward. But what I do want to be is I want a family to say, look, I can rent that 3 bedroom for 3250, or I can get the 5 bedroom for 3850, and that's a huge, tremendous value. By the way, one of the advantages we have is usually that 3 bedroom older product's not going to have a garage. Many times won't have, air conditioning, central air and heat. Certainly is not a new unit. Maybe it's got
Right.
some upgraded finishes. It was a value add deal, but often we will win both on value. In other words, you pay $600 more, but you get way more space. Many more bedrooms. But one of the interesting things, 5 bedrooms is a big deal. But guess what? 4 bathrooms is almost a bigger deal, right? If you're a family of 6 or 8 people, having 4 bathrooms actually is your bigger constraint than the bedrooms, right?
Right.
And in fact, in a lot of the older product, this is sort of the running joke for me. We would find other apartment comparables that was like a 4 bedroom in on Daisy for when we did our original deal, except it was I remember at the time it was 1,000 square foot 4 bedroom 1 bath unit in a 1920s era building, no parking, old building, no
Mhm.
insulation, certainly no air conditioning or cooling, heating. So that sort of is our competition, right? Like
Right.
I will compete with that 4 bedroom 1 bath all day long because I
Correct.
go, I'm a little more expensive, but I got so many things that are an advantage compared to that.
Scott, can you talk to us about the difficulty of building in California and cost?
Mm, yeah.
I listened to one of your podcasts, and you said something interesting. And because I'm not a builder, you said that, hey, the most expensive thing you can build is your kitchen.
Mm,
And what you were saying is, because I'm building more bedrooms, there's kind of a savings in
mhm,
that, because the bedrooms are less. And I guess, typically when at a very basic level, if we're like, hey, cost to build, and I'm making this up, this
mhm.
number may not be right. I might say, it's like $300 a square foot. And we think that the entire house is $300 a square foot, but you're saying actually the kitchen is higher and the bedrooms
Mhm.
are lower.
That's right.
Talk to us about what building in California is like, and the cost to build.
Yeah. Building in California is a total pain in the ass, but
Hmm.
I think anybody who's in California knows that. But I look at building in California as you know, when we talk to investors and other developers, a lot of people go, look, I hate California. I will
Hmm.
never invest there. And I get that. Like it's go, okay, got it, got it, got it. But I say to people like, look, if you connect with the right sponsor, developer, investor, whoever it is, and they understand intuitively the environment of California politically and regulatory standpoint, and they can operate effectively within that, then they can actually deliver a much more valuable product than if you were in an easy market, right? I always use Texas, Dallas, Fort Worth as a comparison. It's really hard to deliver in California, right? It's very hard, but when you do deliver, it's very valuable, right? In Texas, it's easy to deliver, but everybody else is delivering too. And so when you finish it, it's not as valuable, right? So in fact, for Texas, they call it a cash flow market, right? You build it, you cash flow it, but the appreciation is always going to be suppressed because as
Hmm.
soon as values go up, Joe's going to build 500
Correct.
more apartments like next door, right? In California,
Correct.
you can't do that. So I tell people that California is a total pain in the ass, but basically it creates a moat, right? If anybody follows Warren Buffett, Berkshire Hathaway, he has this idea when he buys businesses, he wants to have a moat, and other some sort of protective mechanism that keeps that business safe or competitive. So think like if you had intellectual property, you had an invention, right? And you had a patent on it. That's a moat, right? I
Yeah.
have the protection of this, and that protects me. Well, building in California, the regulatory environment being so difficult is a moat, meaning
It gives you it gives you a harder entry to barrier.
right. That's
And
right.
so like,
That's
okay,
right.
yeah, you could go to Texas and anyone could go there. And
Yeah.
so what you're saying, it's more competitive. California,
Yeah.
hey, it's so difficult that it's just really hard to enter
Yeah, no,
there.
people will say, well, oh, okay, but still it's hard. And I go, yes, it's hard. But so what that job then becomes for us as developers, we have to be really, really picky on the sites that we select, the
Yeah.
locations. Some cities we work in, some cities we don't, right? They're so difficult. But like I've been doing that my entire career. I've only ever really worked in California. I've worked in several other states, but California's my home and sort of headquarters for the company, and all my most of my projects are. So you get really good at picking the right horses to run on. And so what that means is basically 99 out of 100 are, put in the trash. Like it doesn't work. The zoning's bad.
Hmm.
The city's bad, right? Where we are in the economic cycle is bad. Now, every once in a while, like we pick a horse and it doesn't, run the way we want and we don't win. But we've had only one like no vote on a project for our company. In fact, the entire 24 years that I've run Urban Pacific, we've had one city council vote where we went all the way to the city council and got a no. That was
Oh,
Hawaiian
wow.
Gardens. That was like a
Jeez.
couple years ago.
And it's the one place that could use new housing.
Dude, it was crazy. All the people on the city council were really nice, but they were like, our what did they say? Our residents don't need this kind of housing. It's too expensive. And I'm like, are you kidding me? This is like Hawaiian Gardens.
That's the demographic
That's the
that you're
center
catering
of
to.
the world for
Yes.
family
Yes.
housing. And look, people in political situations and political
Have
bodies,
different
they will
motivations.
say whatever stuff they
Correct.
have. I mean,
Correct.
it was a little controversial, but the reason I give that statistic is that what like is not said in there is we don't pick a lot of projects.
Hmm.
There's a lot of stuff that we say no to, right? It's
Right.
got slope, it's got, difficult neighbors, it's got some weird, situation where, the traffic can only go through a neighborhood and those people are going to get pissed off at you if you're rezoning the property. So there's, thousands and thousands of little decision, parts of the decision, the matrix of what for which we say no. So most of the stuff doesn't, make it successfully. Although I will add, one of the things about being in these B and C neighborhoods, these the sort of urbanized, suburban, older communities,
Hmm.
often the land is much more available, and the politics are a little bit more pro business, pro growth. That they understand that they need housing. Like when we built in Montebello, the city was sort of tough, but man, as soon as we opened the doors, there was like, I mean, we had probably half the units rented by Montebello native multi-generational families that showed up and they were like, oh, dude, I didn't know this existed. Like, I want the unit right now.
Yeah.
Like they got it immediately, multi-gen families, Montebello natives. And this is a perfect example of us picking the right location. City was like okay to deal with. And I don't want to make it sound easy. I mean, we still work our butts off to get stuff approved and it's a fight the whole way.
Right.
In fact, my joke to somebody the other day was development's like a series of, 10,000 problems to solve and then you sell the building and make money.
Okay. All right. Well, so long as you're making money. I
Yeah.
mean, well, and you're doing a lot of things. It's not, listen, I've listened to you enough to know that there's a mission behind what you're doing.
Yeah.
I did want to ask if you could just, um, because you brought up making money I want someone to understand, kind of wrap their head around what does it cost price per square foot
Mm.
with what you're building. Now, it could be, Scott, that, hey, Juan, I'm going to be able to build it for less, but you could say, hey, on average, this is what people are paying
Yeah.
for new construction.
Yeah. So what I usually share is like, so right now, depending on where we are for the land markets, we're probably somewhere 400,000 to 450,000 a door today.
Okay.
And so that means as a developer, we have to have a value that exceeds that. If we're building for 400, we want it to be valued at 500 a door.
Hmm.
So, that's all, but that's all in. That's land,
That's all the costs that.
all the costs, city fees, architectural engineering, hard cost to build costs. Because a lot of people, they go, hey, here's my hard cost to build. But I look at it from an all-in standpoint because what I care about is what it all-in costs me to build and what is it all-in valued at when I'm done with it, either in a refi or in a sale.
Mhm.
And do I have a delta between those two, meaning the value is above the cost, right? And in some economic cycles, and we're not in that now, although we're sort of there a little bit, there's sometimes where new construction may be, less valuable than it costs to build. So that means you wouldn't do it.
Right.
And then, in that environment, usually then, apartments would be, you could buy apartments below replacement cost. People have heard this term
Yes.
before. That's a standard thing.
Yep.
That replacement cost can be, in fact, apartment development is that you value as above replacement cost, right? So my replacement cost is my build cost, and I have to have a model where my value is above my replacement cost. That's the opposite of below replacement cost. Now,
Right.
we're in a weird situation right now because there were so many value add deals that were bought on existing apartment deals that
Hmm.
people overpaid for it. They used bridge debt,
Yes.
floating debt, right? And now they're coming back onto the market, and you now can buy them well below replacement cost.
Yes.
And most new construction deals don't work for interest rates and construction costs. It's a weird environment for us because our townhouse stuff is still working, and that's just the model of the bedroom cost and sort of the high whole dollar rent, and being above our build costs. We're still producing good margins, but frankly, we're the only guys that I can see that are able to produce like regularly profitable projects. I don't say that will last forever. I'm not sitting here thinking we're bulletproof, but what I do know is that in California we're so vastly undersupplied that we're never going to catch up. So we're never going to be one of those markets like Austin where you're building 10 or 20,000 units. We'll always have, more demand than we have supply. And that's just a function where we are in the economic cycle. What I do know is that the demand for housing from multi-gen, middle income, working class families is still off the charts, and still no one is supplying that. And so we're sort of in a little protected, harbor, if you will. And that's one of the reasons we picked it. I mean, we picked it to
Right.
be in a situation where we'd be resilient, going in.
Scott, when you're talking about we're never going to be able to build enough, there's so much demand. So a lot of the people we serve are multifamily investors, and so these are people that are just getting started buying their first fourplex ever, with 5% down, and that's going to be the first one. But that's their first of many, and we've seen this pattern go on through years where it's almost like I figure like the fourplex is the gateway to a larger portfolio. It really is. Once you get one under your belt, and you realize, hey, this is not that hard. I could manage this. I could lease this. Wow, it's doubled in value in the last 10 years. Wow, this was not that hard. So that's kind of what I've seen. And sometimes people will ask me, well, hey Juan, the returns, the cap rates, et cetera, are not enough in California. And I'm like, well, what are we chasing? Are we chasing cash flow? Are we chasing appreciation? And sometimes people are wondering, well, is there still demand? We're reading that people are leaving California, although yesterday's LA Times said quite the opposite. But it's interesting where you're saying, hey, there's so much demand here. To me, if we're talking to apartment owners or um, income producing owners or soon to be income producing owners,
Mhm.
if there's this demand that's not going to be met, to me, it's like you're buying a business that the day you close the escrow. If there were a vacancy, there's kind of a line of people waiting to
Mhm.
lease it because there's that much demand.
Yeah.
And I would say there's demand for studios, one
Mhm.
bedrooms, two bedrooms. And to your point, you discovered something that maybe no one had really tapped on
Yeah.
is, hey, there's demand for five bedrooms.
Mhm.
And so with that demand, listen, anytime we buy a rental property, we want to make sure that someone wants to lease it. And if you're in Southern California, that's never really a
Yeah.
concern.
Yeah. I
Yeah.
agree.
Yeah.
I agree. I mean, look at it from like a political standpoint. We've been in undersupply mode for probably since the early 70s. And that time period, if anybody remembers what happened, that's when the Coastal Commission was formed. That's when CEQA, California Environmental Quality Act, got put in place. That's when most of the cities in California downzoned all their, like most cities. If you look at a zoning map, it's lots of yellow. That's single family R1, single family homes, suburban homes, that kind of thing. A lot of cities that used to be R3, meaning multifamily. Well, in the 70s, a lot of cities downzoned across the board. They said all that's R3 is now R1,
Mhm.
and I can't remember the numbers, but I think our ability to produce a total number of units was cut down by like a factor of like, like 8 or 9 times. In other words, we went from, a million units we could produce down to 100,000, like that sort of magnitude. Down zoning, meaning reducing the number of units that we can build under the zoning, right? And that's in California, the regulatory environment, like we live and die on the zoning, right? Can we
Mhm.
can we rezone it? Do the neighbors fight us? Does it have the zoning we need? And the reality is that we've been in that political environment for so long that not only do we have the annual undersupply in any given year, but then we have the totality of every preceding year back to whatever 1971. I'm picking a
Yeah.
year, and so there's studies out there. Let's see, Harvard's Joint Center for Housing Studies did a study about Southern California, and they think we have a million unit shortfall in Southern California by itself.
Wow.
I mean, just think about that. It's a million units. And by the way, I can't remember the exact numbers, but I think California does something like 80 to 100,000 statewide every year. Do the math. I
Right.
mean, a million units, even if you argued it's true or not, you could just go, look, we could all build for as much as we could for our lifetimes and never put a dent in that number.
Well, one of the questions I get is this still a good time to buy, or should we just avoid California?
Yeah.
And and I have to answer that all the time. I'm
Hmm.
like, of course it's a great time to buy.
Yeah.
You just confirmed it.
Yeah. Yeah.
We need
Yeah.
you said 1 million
In
m-
Southern
in
California
Southern
alone.
California. That's
Yeah.
not even the entire state,
No,
but
that's
yeah,
not the Bay Area. That's not
yeah,
San Diego. I mean, if you do the math, I don't, I think, our illustrious governor at one point said we were at a 3.5 million unit housing shortfall statewide.
wow,
The numbers are all over the place, so they get a little,
sure,
they get a little tricky as you get that big. But where I go philosophically is like, look, we're in a multi-decade supply constrained model. Or we're putting some new housing laws in place now. That's pretty good. That's sort of increasing accessory dwelling units. That's like a new popular thing that's
yep,
happening a lot.
hmm,
But the reality is, it's going to take us several decades to build our way out of it if we ever do. So at least from a new housing demand standpoint, I don't really worry about that at all. That's part of the moat, right? That moat I
correct,
described earlier.
correct. No, that makes perfect sense, and thanks for sharing. I wanted to talk to you about there's a lot of changes in South LA.
Mhm.
Properties that had zoning of say like R3, so
Mhm.
typically you could build 3 units on it. Now they're allowing it, and I'm being told this, so you tell me
Mhm.
that they've changed it. So now they're kind of where they were downsizing.
Mhm.
Now they're kind of reversing that on some parcels in some areas, so that R3 could potentially build 30 units so long as it's low,
Mhm.
um, uh, so long as it's affordable housing,
Right.
less parking, and all
Yeah.
that kind of stuff. I see a lot of new stuff going on in South
Mhm.
LA, and I sell in South LA, and I see a lot of new product coming on.
Yeah.
And on the resale side, I see it. It does change the neighbor. It makes the neighborhood better.
Yeah.
I mean, by
Yeah.
all means, it's new. It's bringing in new product that a lot of the tenants in that area have never been
Mhm.
exposed to. Um,
What are you seeing that's new? Like, just give me a couple
I'll,
examples.
I'll give you an example. So people are tearing down like a single family home, and I'll see like four, five,
Mm.
6 units brand new.
Yeah.
And so there's a lot. So you could go into LA right now, and around $2 million will get you a brand new 7,000 square foot 4 unit building.
Yeah. So
These
you're
are all,
talking like the double duplex, two
yep,
units in the front, driveway, two
yeah,
units in the back,
yeah.
that kind
And
of thing.
you're
Yeah.
seeing a lot of that,
Right.
and you're possibly friends with some of the developers
Hmm.
that are pulling that stuff off.
Yeah.
But now what I'm seeing, and I'm being told like, hey, that's the old model.
Hmm.
Now instead of doing 4, we're looking to build 30
Yeah.
on these things, and that the city's saying yes. And I think, well, more housing has to be a
Hmm.
good thing. Is it a profitable thing? I don't see, I
Yeah.
don't hear you talking about going out there. So I'm
Yeah.
just curious because I do hear it. People are asking me and like, Juan, why don't you do
Yeah.
it? I'm like, I don't know how to
Yeah,
build.
so City of Los Angeles proper, the
Yes.
actual municipality of the
Yes.
City of LA, is a really interesting place to me. But it's a total dichotomy. Okay, so it's got some of the most aggressive zoning that exists in California, even in the United States. Like, I love LA for R3, R4, R5 zoning. You got the TOC stuff. You got
Yeah.
the ED1 stuff. Is probably part of the thing you're referencing, which is sort of a new affordable housing program under Mayor Bass. But then on the flip side, we have ULA, right? And for those who don't know, ULA is the mansion tax they describe, which any property that's above a certain dollar amount will have a 5% tax, just taken off the top when you sell it. And so the dichotomy is, and also I put on that side of the formula, the regulatory environment for landlords, very landlord unfriendly. So I would love to do a bunch more in LA, and I know all the things you're talking about. In fact, South LA was a place that we studied when we were first doing this townhouse product and that double duplex stuff. And that's
Mhm.
all over LA. I mean, that's on
Yes.
the west
Okay.
side, that's in South LA, that's in North Hollywood. I mean, all kinds of different places. And you're right. I think that model, I think the model, the double duplex model is probably going to come back because the doing the 30 units on that same site, you get a lot more density, but it's a lot more costly to build. And so
Mhm.
this is the trade-off. Like just before we described our model is that lots of bedrooms, lots of cheaper space, high gross dollar, high whole dollar rent. When you do those really dense things, people go, "Oh, they must make more money." And you go, well, they do revenue wise. You have a very high, price per square foot on rents, right? Maybe the unit's smaller, so it's a lower whole dollar rent. But the problem is then it costs a lot to build that higher density. It's a more expensive construction model. And
Right.
so where you really want to be is the crossing point, the equilibrium point of the lowest cost build that generates the highest revenue, right? You want to be at the crossing point, the equilibrium point of those. And so why a lot of higher density deals, podium or whatever describes the higher density, that stuff's not working right now because the costs have exceeded the ability of the project to generate revenue to make it feasible. Now there's
Mhm.
some exceptions. You've got the ED1 program in the city of LA, which is sort of an ostensible affordable housing program.
What does that stand for? ED1.
ED1, actually, I don't know what ED1, maybe economic development. I don't know. I just know that the terminology, but basically what that program says, if you fit all the units within a certain affordability category, and there's published rents that the city of LA publishes, then you get all kinds of crazy zoning relief. You don't have
Correct.
to do parking,
Yes.
your setbacks are less, you can go really dense. And so there's a whole like just plethora of these ED1 projects. There's like hundreds now. In fact, if people go on real estate Twitter and type in ED1, I mean, you'll have a whole like education of all kinds of people doing the deals, how does it underwrite, all that kind of thing. One of the challenges that we're starting to see is that the rents that are needed to make these deals feasible in lower income communities like South LA, the economics are tough to the point where they probably don't work.
Yeah.
And people will argue with that. Now what we're starting to see is ED1s going into higher income, like say West Side, Santa Monica adjacent sort of LA. So ED1 is only in the city of LA. So
Mhm.
that's an ordinance in the city of LA. So if you go to Santa Monica, that doesn't exist. So it's only LA. But yesterday I read that there was um, the daughter of a well-known real estate family had put forth, she has like 15 or 20 ED1 projects, and they're all high rises. I mean, basically they're like 8 or 10 or 12 stories tall,
Mhm.
very, very dense, almost no parking. And this family and the lead, this young lady who represents the family, they had done all kinds of West Side ED1 projects, which that probably makes sense because in those West Side markets, the rents are very high. In fact, she was going to do one in Westwood Village.
Mhm.
And the comment that the person who wrote the tweet is, Westwood Village hasn't seen any high rises in decades. Like Westwood's been sort of dead that way, and so this
Right.
would be the first one, and it will be one of the ED1 projects. So those kind of things are interesting. Now, if you do an affordable housing project like that, you're exempt from ULA. So there's an interesting dichotomy there. But often the ED1 projects or affordable housing projects aren't really meant to be classically profitable. It's not like you build that building, rent it up, and the value's above the cost, and you sell it and you keep the profits, right?
Right.
And I'm not saying that doesn't exist in that environment, but the ED1 program is more of an affordable housing style thing, which usually means that the profit is less, maybe none from a structure standpoint, or the cash flow is going to be less. So those projects are, classically not intended to be highly profitable because you got to reduce the rents, you got to keep the costs down. They're intended to produce affordability than more than profitability. And there's nothing wrong with that. It's just that's just a different business model.
Right, right, and it seems tricky. I think from the outside looking in, you're like, wow, the parcel doesn't seem to be all that expensive. You are able to negotiate right now in those types of areas, and I'm talking about South LA.
Hmm.
And then you count the number of units, you figure out the rents, you put it on a cap rate, and you're thinking, "Wow,
Yeah.
I'm gonna retire rich
Yeah.
quick." But
They look
it
phenomenal.
looks
Yeah.
phenomenal, but not knowing everything going into it and not having
Yeah.
your experience of development.
What I see I've had that exact experience. So I've somebody sent me a site on San Pedro Street in South LA, I
Mhm.
think it was, or maybe it was like, south of downtown. And I remember like you could put a whole bunch of units on this really tiny site. You can buy the site for basically the cost of the house. So
Yeah.
that's a good price. You put a boatload of units on it. And then if you use the published rents for ED1, it looks amazing. right? You're renting the studios for, let's say, I don't know, 2000 a month was one of the published rents. I may have the exact number wrong. But then what you got to do is you got to go, okay, I can use the published rents, but is that the real market rents in that location? And when you look at San Pedro Street, at least in that, like I couldn't get anywhere close to that.
Got it.
I think we underwrote it like $1,600 a month for the studio unit. I'm going off memory here, so I may have the facts incorrect. And so when you go from 2000 a month to 1600 across the board, then the deal doesn't look so good anymore. And so those, I've had that exact
Yeah.
experience. It was like getting like a 9% yield on cost, which is like way above market. It's like, man, this is fantastic. But then you start to look at the reality of it. And this is this is a classic underwriting process for developers, and new developers will always sort of trend towards that. Like it looks really good and you sort of believe it
Mhm.
and you get, sucked into it. My job as a seasoned developer is to basically not believe it. Like I like look at it, I go, 9. I love that number. I don't believe it. So like what's wrong here? And you sort of
Right.
beat up the numbers until you either, you get truthful, real data that you can prove and support, or the deal died. And so
Yeah.
that one died.
No. Interesting. So investors out there, beware. Okay,
Yeah. Yeah.
not everything is going to be easy, and
Yeah.
it's going to have its challenges. But I'll tell you this, Scott. I don't think anything's easy.
Yeah.
I don't think there's a business that I've seen where I've ever thought, man, that person's making easy money.
Yeah.
Because at some point there was a lot of risk and a lot of money had to be put up, and then the deal structure, the business model was tough to implement, and
Yeah.
nothing's really easy. I did have a question, kind of unrelated to real estate, but I've kind of noticed this. You and I don't know if a lot of developers do this, but you tend to give back a lot,
Mm.
just in terms of your knowledge, your YouTube channel. Like you have a really robust, like your emails go out, you get people updated, you're on podcast all the time. And what's the reason, I guess, what's the motivation
Mm.
behind it? Because I'll tell you this, Scott, when I first, so as a commercial broker, I was one of the very few to have a YouTube channel
Mm.
and start showing people what I know. And
Yeah.
now either you believe that I know what I know, and then like and trust me, and you
Mhm.
decide to work with me, or you decide maybe we're not going to have a good vibe. And so in the world of commercial real estate, and I would imagine development, we've always been to what you said at the very beginning, where we don't want to
Mhm.
give our secrets or show too much of what we do because someone might try to mimic us. But
Mhm.
I've noticed that's not really ever been your concern.
Yeah.
You have no problem having your phone giving us like a selfie update with a foundation being built
Mhm.
behind you, and hey, this is what's happening today, and they're tearing everything up, leveling
Yeah.
out the land. Where does that motivation come from?
Mm. So I think it comes from a couple different places. So, um, one is I think where we are in the environment today. So my comments about Twitter and being able to share, I think we now have new like mechanisms to share that we didn't have before. I mean, we didn't have Twitter, Instagram, or YouTube.
Yeah.
Even 10 years ago it would have been, they were there, but no one really used them. 15 years ago, they weren't there. 20 years ago, like, it was the newspaper and magazines, right? So I think the capability to communicate these things real time is like much more robust. Okay. So that's number one. Number two is, so I've studied with it's like a learning group called the Aji Network. And the founder of Aji is this guy named Toby Hecht. And he always really had this great philosophy of business, which is basically giving and receiving powerful help, right? If you look at the most powerful business individuals in the world, the Elon Musks or, famous people like that, people are always sort of focused on, how like badass a business person are, or it's the old age, like how much of a jerk are they? They punish their people. But I look at, Toby taught me a different way, which is if you look at the really top performers in business, they're giving really great help. So let's use an example. Bill Gates, right? He founded Microsoft. Well, what he did is he created the DOS operating program,
Hmm.
right? And he sold that over and over again. If you look at DOS not as a piece of software, it is, but as an offer of help that you for which you'll pay money to operate your computer, which by the way, the computer is the best source of help. Well, then you're going to pay for that and you're happy to pay for it. You go, gosh, I get so much value and help out of this, handing over $50 for the DOS,
Hmm.
software, great. Like, and so all the, most wealthy people and the most successful people in business are really great at giving high value help, right? That's their offer into the marketplace. But also, interestingly enough, they demand help in return. Not in a demanding way like you shall give me, but like, I'm Jack Welch, right? I run General Electric. I need 300,000 people who work for this company to be really valuable offers of help. I can't do what they do. I
Hmm.
don't do accounting. I don't do manufacturing. I need the best of the best, right? The old adage, don't be the smartest person in the world, is means the other people that are smarter than you in the room are very valuable help to you, right, as the business person. And so
Right.
it's that back and forth of giving and receiving very powerful help. So
Hmm.
that's number two. And then for me, number three is my Christian faith. So I think just helping people is part of my fundamental faith. Um, and interestingly enough, the stuff with Toby Hecht and my Christian faith like sort of melded together at one point. That I was like, oh, if I can take care of really good care of people in whatever way that is,
Hmm.
whatever way I have capacity to do, that I'm going to do that. And sometimes it's profitable, and often it's not. I'm always trying to build, networks for the future, to create future possibilities of doing business. Maybe I help that person now, and it'll come back to me some days. But gosh, I'm on probably at least two phone calls a day of people who reach out to me through Twitter and are just young people. They're trying to figure out a deal, or they need help, or they
Hmm.
just want to find out what I'm doing. Every month I do a Spaces event on Twitter, right?
Yeah.
If anybody knows Spaces, it's sort of like a conference call where everybody dials into the space on Twitter and you're asking questions. I do that monthly because I just figured out, I was like, I got people calling like, hey, just bring me your deals. Like, what
I-
deal? Like, you got a problem deal? Like, bring it to the Spaces event.
Is that a consistent thing? Like, is it
Yeah.
like every
Yeah,
Thursday
every
or?
every second Wednesday at 11 a.m. Pacific. If you go on Twitter and
Yeah.
search me in Spaces, you'll find it. And it's just a space. People show up and they go, "Hey, I got this deal. It's not working. I got this problem. I'm stuck with the city. What do I do?" And
Yeah.
well, like it's a lot of me, but I also want a bunch of other smart people to come into that space
Right.
and go, "Hey, I did this, I did that." Again, this sort of whole Twitter thing.
Yeah.
So I think it just this is probably the biggest takeaway is like let's see, I'm gonna be 57 this year in August. Um, just the willingness to be a great offer of help and get great help in return
Yeah.
has become like the center of my business life, in the sense that like I need to do both. I need to
Right.
give valuable help and receive valuable help, and everything I do is through that lens. Like there's nothing that I do, even when I teach my kids, I got a couple that are going to graduate from college. My oldest will graduate from USC this year. And that's like a whole mantra I have with him. 20-year-olds look at what I think philosophically a little bit different than a 50-year-old, right? Who's sort
Hmm.
of been, seasoned. But nonetheless, the ability to, transact with humans and human businesses, like the fundamentals. I mean, in the old days, when we're in, caveman days, it's like, hey, I need you to hunt that deer and I need you to collect those berries, and that's your help and here's my help. And
Yeah.
I mean, it's very, very fundamental to who we are as human beings.
Well, Scott, I appreciate you helping us today,
Mhm.
and we have a big following, and they're super loyal, and they're hungry for this information. So I encourage everyone to tune in to Scott. Scott, where should people follow you? Like, where's the best place?
Yeah, so I would certainly, well, we've talked about Twitter a bunch today. So my handle is at Scott Choppin, SCOTTCHOPPIN on Twitter. And then I would also, I would encourage people to go to Substack, which is a newsletter, and
Okay.
look up this, the name of our newsletter is called The Real Signal. And that's a curated set of articles and a bunch of my writing every Saturday. Basically, it's sort of my economic research for the week, shared, all the articles that I think are important for our business, and I keep those and I capture them throughout the week, and then I share those out every Saturday. So just go Scott Choppin Substack, Real Signal, and you'll come up. And so get on the newsletter list, and then hit me on Twitter, and those are the two best places.
What about for people that may want to maybe invest with you in the future?
Hmm. Yeah, for sure. So if people want, they could just email me. My email is my last name, Choppin, Choppin at urbanpacific.com.
Mm.
People can send me an email. In fact, if people want to go to our website, we're in the middle of update and rebuild on our website, but our phone number is on there, so people
Mhm.
can call that as well if somebody wants to call.
Awesome. Thank you so much for being here, Scott. I'm going to give you the final say. Anything you want to wrap us up with?
um, Here's what I would say. The economy is doing crazy stuff right now, but I'm a firm believer in the American economic system and the America as a nation. I know we're going to come back out of whatever we're doing right now, sort of crazy in the real estate business. I mean, you
Yeah.
know that as well, Juan. But I'm a firm believer this would be the second recession that I've gone through. For some people they go through it easy, some people it's tough. I would just, say to people who are having a tough time, it will get better. For those people who are, doing great, there's a lot of great opportunities to capture. I mean, I think, we're in sort of certain domains of real estate or distress, but I think there's tons of opportunity. So I'm bullish on the long run future of, what we're doing in California and the US.
Awesome. Scott, can't thank you enough. And we will definitely have Scott back if he's willing to come back. Thank you so much.
Thanks, Juan.
Bye bye.